The debt trap: how four men designed a system that owes itself. 1. The global illusion. Every country on earth is in debt. The United States owes $38 trillion, Japan about $9 trillion, and the world altogether a staggering $315 trillion, roughly 3 times the size of the global economy. So what does that actually mean? It means the entire planet is running a balance sheet that doesn't add up. Everyone owes everyone. Here's the paradox. If the world owes money, then who exactly is owed? When you follow the chain of creditors, you end up at a disturbing realization: the world owes money to itself. Debt isn't disappearing, it's recycling. And that isn't an accident. It was built that way. 4 men, 4 centuries, 1 outcome. They didn't know each other, but they designed the same machine, a global system of perpetual debt. It doesn't end, it compounds. Governments don't pay it off, they just service it, forever. Footnote. The modern debt structure is not the product of chaos but of deliberate policy evolution across centuries, turning borrowing into a permanent economic engine. 2. William Paterson, the man who made debt immortal. Before 1694, kings borrowed money the old-fashioned way: beg, borrow, default, repeat. Debt was personal and temporary. Enter William Paterson, a Scottish schemer with a revolutionary idea. England needed money for war. Paterson offered a loan of £1.2 million, with a twist. The principal would never be repaid. In return, lenders would receive interest forever, guaranteed by Parliament and backed by taxes. Thus, the Bank of England was born, the world's first institution built to turn government debt into money itself. So what does that actually mean? It means Paterson invented a financial perpetual motion machine. Governments borrow, pay interest endlessly, and call it stability. Footnote. Paterson's 1694 innovation established the first perpetual national debt, transforming interest payments into a permanent fiscal fixture. 3. Nathan Rothschild, the man who made debt global. Fast forward a century. Enter Nathan Rothschild, the man who turned national debt into a worldwide business. Before him, governments borrowed from individuals. After him, entire markets traded government IOUs. Rothschild created the secondary bond market, buying government debt at a discount, selling it to investors, and pocketing the spread. Then came his masterstroke: interconnected ownership. A British bond could end up in a French bank, pledged for a loan in Austria. Defaulting on one creditor now meant collapsing an entire network. So what does that actually mean? It means the Rothschild made default politically impossible. The system became self-defending. Footnote. By industrializing sovereign debt and globalizing ownership, Rothschild ensured perpetual repayment through systemic interdependence. 4. J.P. Morgan, the man who made debt infinite. By the early 1900s, America needed a mechanism to keep the game running. Enter J.P. Morgan, who decided that one man, or one bank, should be able to print money. In 1910, Morgan's circle secretly met at Jekyll Island to design what became the Federal Reserve System. It wasn't a public institution. It was a private network wearing a government badge. The Federal Reserve could create money by buying government bonds, which meant the U.S. government could now borrow without limit. So what does that actually mean? It means the bankers built a machine that buys its own promises with money it invents. Genius, right? If you're the one collecting the interest. Footnote. The 1913 creation of the Federal Reserve institutionalized limitless government borrowing through money creation, cementing perpetual debt monetization. 5. Paul Volcker, the man who made debt inescapable. By the 1980s, the trap was global, but developing nations were breaking under it. Then came Paul Volcker, the Fed chairman who made sure the trap held. When Volcker raised interest rates to 20% in 1979, developing nations couldn't pay. Instead of letting them default, the IMF stepped in. Countries like Mexico and Brazil were rescued with loans that came with harsh conditions: privatization, austerity, loss of sovereignty. So what does that actually mean? It means countries weren't bailed out, they were bought out. The interest kept flowing, and debt became a leash. Footnote: Volcker's 1980s policies globalized the debt trap, institutionalizing perpetual dependency through IMF loan conditions and restructuring. 6. The system today: everyone owes everyone. Now the trap is total. The United States owes $38 trillion, Japan $9 trillion, Europe $14 trillion, and the rest of the world owes the rest, to itself. The lenders? Pension funds, central banks, and asset managers like BlackRock, Vanguard, and Fidelity. They collect the interest, about $1 trillion a year, paid by taxpayers worldwide. If governments ever paid off their debts, the money supply would collapse. Why? Because in this system, money is debt. Paying it off would delete the dollars themselves. So what does that actually mean? It means we're all tenants in an economy where rent is called interest, and the landlords never leave town. Footnote: The global debt ecosystem relies on continuous borrowing to maintain liquidity. Repayment would trigger systemic deflation and collapse. 7. The Four Architects, the Perfect Loop. Paterson made debt permanent. Rothschild made it global. Morgan made it infinite. Volcker made it inescapable. Together, they built a system where governments borrow forever, taxpayers pay forever, and the same institutions collect forever. It's not corruption, it's architecture. So what does that actually mean? It means the debt isn't a crisis to solve, it's the foundation the system stands on. And interest is the rent we pay to live in their world. Footnote: The four-stage evolution of global debt institutionalized a self-perpetuating economic structure prioritizing financial continuity over fiscal solvency.